Welcome back to the Deep Dive. Today, we are definitely strapping in for an intense, high-speed analysis of the crypto market. Because, well, as of September 26, 2025, the volatility dial is just cranked way up. We're seeing sharp corrections really fueled by macro pressure. My mission today is pretty simple. You share this stack of recent financial, regulatory, and on-chain sources, and we are going to distill the most crucial information, like the big forces moving prices right now. So you can be instantly well-informed without, drowning in all the data. We're aiming to cut straight to the core.
And the core really is this. Our sources point to what looks like a critical turning point. It's driven by the convergence of, well, three heavy forces. You've got the external pressure from US and EU macro policy shifts. That's huge. Then there's the continuous kind of quiet evolution of exchange-traded products, ETPs, ETFs, and maybe most visibly right now, a sharp and sudden swing in investor sentiment has plunged us into deep fear territory. The combination of these external and internal factors, that's what makes this moment so crucial for understanding the road ahead.
Okay, right. Let's unpack this then. Starting with those huge forces pushing down on the entire global market. Macro policy. The instability seems to be coming directly from the political sphere, doesn't it?
Yeah.
We saw specific U.S. policy moves causing instability pretty recently, most notably President Donald Trump announcing a series of new tariffs.
Precisely. And those tariffs were specifically targeting pharmaceuticals, heavy-duty trucks, and various other products. What's critical here isn't really the items themselves, but the geopolitical signal these tariffs send out. They raise these deep concerns about escalating global trade tension. And that has a tangible financial effect.
Yeah.
It basically sucks global liquidity out of the system, and it diminishes overall investor risk appetite. This has a high influence, and it hits all asset classes.
All of them?
Equities, commodities, and yes, absolutely crypto.
Right. It's like the global economy just slammed on the brakes, and crypto being, the highest beta asset class out there, it feels that deceleration the most. But while the U.S. is tightening global trade, the EU seems to be moving ahead with digital stability. We saw a movement from the ECB on central bank digital currency research, CBDCs.
Yeah.
That was highlighted in their economic report, number 6 of 2025, and they had results from their digital euro innovation platform, too.
That progress is definitely a long-term legitimizer. It confirms central banks are taking the underlying technology seriously, a different angle entirely. But turning back to the U.S. regulatory structure, that's perhaps the biggest long-term driver for adoption right now. We have a really critical upcoming meeting. The SEC and the CFTC are holding a roundtable on September 29th.
Okay.
And it's specifically about efforts to harmonize regulation.
Harmonize. Finally. And the intention seems pretty clear, right? The new SEC chair, Paul Atkins, he's specifically noted his aim is to establish a clear regulatory framework for digital assets. That kind of clarity is something the market has been, basically begging for years. If they actually manage to pull this off, what does it unlock first? What's the immediate impact?
Stability and efficiency, really.
Yeah.
Clear regulation, especially the potential adoption of things like the Genius Act for stablecoins. That's a foundational key.
The Genius Act. Okay, remind us, what's the core idea there?
Sure. So for the listener, the Genius Act is essentially legislation aimed at creating a federal framework specifically for stablecoins. It would require specific reserves, transparency, things to properly back those digital assets.
Got it. So it's about making stablecoins truly stable and, importantly, regulated, building trust.
Exactly. This clarity is what will ultimately drive the actual adoption of stablecoins for both wholesale and retail payments down the line. We really need the rules of the road before the big institutions feel comfortable flooring the gas,
Yeah, that makes sense. Rules of the road. But while regulators are slowly paving that road, the immediate volatility is causing some real pain right now. Let's talk about the sharp correction we just saw. That macro instability, it contributed to some major, pretty painful liquidations over the last, 24 to 48 hours. BTC fell below $109,000, ouch.
Huge drop.
Wiped out $170 billion in market cap across the whole ecosystem, and triggered over $1 billion in liquidations. Billion with a B.
And that pain wasn't just confined to Bitcoin, unfortunately. ETH dropped below $4,000,
Right.
causing another, $183 million in losses for traders. The altcoins, predictably suffered worse. In these high-risk, volatile environments, capital typically flows immediately to safer assets. And in the crypto world right now, that's still Bitcoin.
The digital gold narrative holding strong in a crisis.
Exactly. And that puts significant downward pressure on most altcoins, especially those in, highly sensitive sectors like DeFi, decentralized finance. But here's where it gets really interesting. If you connect the short-term pain to a potentially monumental long-term trend. Our sources show that the number of public companies adopting Bitcoin as a reserve asset, it's surged.
Surged how much?
From just one company, basically, to over 75 now.
75. Public companies holding Bitcoin on their balance sheets.
That's right. This corporate adoption trend is now a major factor to watch.
Wait a minute, though. 75 corporate treasuries holding BTC. I mean, that sounds like a powerful narrative shift for sure, but is that really more powerful than an entire nation adopting it like El Salvador did? Why would corporate adoption be fundamentally stronger than state adoption?
That's a great question. It comes down to mandate and stability, or maybe persistence is a better word. See, a nation-state's adoption, well, it can be reversed pretty much instantly by a change in political regime. We've seen how politics can shift. Corporate adoption, though, especially among large public companies, it involves things like shareholder approval, treasury mandates, rigorous accounting standards. And it usually reflects a long-term commitment to balance sheet strength and diversification. It's stickier.
Ah, I see. So it's less dependent on political wins.
Exactly. It shifts Bitcoin from just being seen as a speculative asset to being viewed as a calculated treasury reserve strategy. And that builds a much more durable sort of institutional floor for the price over the long run. It's a fundamental change in how it's classified and used.
That reframing makes a lot of sense. Okay. Stabilizes the asset's utility case. Shifts the narrative. Treasury reserve, not just speculation. That is a massive long-term bullish signal, even if we're feeling the immediate pain right now. All right, let's talk about how institutional money is still trying to get in, despite this dip. Let's move to section 2, the ETF effect. We are seeing continued institutional interest in building out the infrastructure, right? BlackRock, for instance, filed for a premium ETF. What's that about? It's designed to enhance BTC yields.
Yes, they're looking beyond just simple spot exposure now, trying to offer yield generation on top of the Bitcoin price itself.
Interesting. And Bitwise is also jumping in.
They are filing for a spot hyperliquid ETF. That's HYPE.
Hyperliquid. Okay, what is that exactly? For those who might not know.
Sure. Hyperliquid is a decentralized perpetual futures exchange, a big one in the DeFi space. So a HYPE ETF would give traditional investors exposure to the derivatives market of a leading decentralized platform.
Wow.
It really shows how sophisticated institutions are getting now, trying to bridge TradFi with some pretty cutting-edge DeFi protocols.
They are definitely still building the bridges, even when the water's choppy like this. So the message is patience, even when the immediate data looks scary.
Absolutely. An executive at BlackRock actually noted that institutional adoption of these Bitcoin ETPs is still very much in the early stages, early innings.
Right.
Which implies there's significant future growth potential remaining, despite the current market fear and volatility. The smart money, it seems, is viewing this as a long game. Building out the infrastructure is key.
Okay, but the psychology of the retail traders, maybe short-term traders, it's certainly not following that calm, long-term view right now. The mood swings in the market are pretty dramatic. The fear and greed index has dropped sharply, down to 28, deep into fear territory.
It is, and that's the lowest level we've recorded since mid-April. So yeah, significant fear out there.
What's driving that specific fear right now, besides the price drop?
Well, that fear is definitely being exacerbated by a very specific and immediate pressure point. The market is bracing for the expiry of a massive $22 billion worth of BTC options contracts this coming Friday.
$22 billion, that's huge.
It's the largest ever, I believe. And options expiry of this magnitude, it traditionally leads to extreme volatility. It's often driven by traders trying to, let's say, influence prices in the short term to maximize their strike price outcomes.
Pinning the price.
Exactly, which usually translates into, or at least contributes to, short-term selling pressure leading up to it.
Okay, so we've got a mix of genuine panic from the macro situation and this predictable structural event causing maximum turbulence right now.
Correct. But stepping back for a second, the rise of these more sophisticated structured products, the ones offered by traditional asset managers like yield-enhancing ETFs, it signifies something deeper than just the current fear, I think. It shows this powerful and, frankly, deepening integration between traditional finance, TradFi, and decentralized finance, DeFi. These kinds of financial tools, they drive market maturity, they make the asset easier to access, and, crucially, easier to risk manage for these huge pools of capital.
That's helpful context. The plumbing is definitely getting better, much more sophisticated, even if the house is shaking a little from that external macro storm right now. Okay, let's move to section 3 then. Let's review the key indicators that you, the listener, should probably be monitoring daily to understand and maybe navigate this market moment. First up is the one we just mentioned, that psychological gauge, the Fear and Greed Index. Currently at 28, that's labeled fear, and it's down significantly from 44 just yesterday and 53 last week. Big drop.
It is.
Now, while extreme fear like this can sometimes signal the potential buying opportunity for contrarians,
Right.
buy when there's blood in the streets,
Right, the classic contrarian indicator.
it undeniably confirms the current deep investor anxiety. It's a good metric to sort of measure how much panic might be left to be sold off.
Exactly. The second metric is critical because it tells us what the institutional money is actually doing, not just saying that's ETF flows. And we've seen significant net outflows recently, negative $504.6 million USD in the last 24 hours alone from the Bitcoin spot ETFs.
Oof, $500 million out in a day.
Yeah. Continuous outflows like that, they show a lack of short-term institutional confidence. It's a really critical barometer of immediate sentiment.
But I have to push back a bit on indicator number 2.
Mm-hmm.
If institutions are pulling $500 million out, isn't that a sign that maybe the long game idea is a bit premature? Are they really just waiting to buy the dip, or are they genuinely spooked by the volatility and getting out for a while?
That's fair. It's more likely a sign they are risk managing actively. Remember, these are professional asset managers. They adjust exposure based on macro signals, like those U.S. tariffs we talked about, not just crypto-specific news.
Right.
So they aren't necessarily abandoning the market entirely. They're likely reducing short-term risk exposure ahead of major events like this massive options expiry.
Right, de-risking.
Exactly. What we need to watch is if those flows stabilize or maybe even reverse next week after Friday. If the outflows continue persistently, then that would signal maybe a deeper structural problem or a more prolonged risk-off period.
Understood. So watch the trend, not just one day. A tactical retreat, perhaps, not necessarily a full abandonment.
Okay.
And indicator number 3 is crucial, especially for altcoin investors. BTC dominance. You mentioned it's currently at 58.3%.
That's right, 58.3%.
What does rising dominance like that tell us about how capital is moving within the crypto ecosystem itself?
It's the ultimate flight to safety within the crypto space. Dominance is simply the ratio of Bitcoin's market capitalization versus the total crypto market cap. When it rises, like it is now, it clearly means investors are moving capital out of riskier altcoins and back into Bitcoin. Bitcoin is still seen as the crypto world's safe haven asset during times of uncertainty.
Gotcha.
So it confirms that the current risk-off environment is hitting altcoins disproportionately hard. So navigating this volatility, well, it means looking ahead maybe 24 to 48 hours first. We anticipate continued high volatility, particularly around that options expiry event and just the general negative macro news flow. Bitcoin may very well test lower support levels before it finds some stability. That seems probable.
Okay, so brace for more bumps.
Pretty much. Now, while this is absolutely not investment advice, we can offer some strategic takeaways based on the source analysis purely for risk management perspective. First, and this is critical, extreme caution must be exercised with leverage, given the speed and the scale of the recent liquidations.
Yeah, that $1 billion figure speaks volumes.
It does. That's a lesson learned the hard way by many in the last 48 hours. Leverage gets wiped out fast in moves like this.
Okay, caution with leverage, got it. And second,
For those tracking the market closely, focus on key support levels, specifically the short-term and long-term holder realized price.
okay, that sounds technical. Explain the realized price concept a bit more. Why is it important?
Right. So the realized price is basically the average price at which all coins were last moved on-chain. It represents the average cost basis of the market. If the current market price falls below the realized price, it means the average investor is now sitting on a paper loss. That's psychologically significant. Now, if the market price falls below the long-term holder realized price, that's the cost basis of coins held for, say, over 155 days that often signals market exhaustion.
Exhaustion meaning.
It suggests that even the most committed, patient investors, the long-term holders, are now underwater on their investment. That can often trigger capitulation, the final give-up, which historically often marks deep market bottoms. It's a key level to watch for signs the selling is truly exhausted.
That context is incredibly important. Wow. So we need to look for potential capitulation among the long-term holders as a signal of maybe The worst being over.
Precisely. It's a strong historical indicator, though never a guarantee, of course. And third, maybe think about diversification into what seem to be strong long-term trends that might weather this storm better. Things like stablecoins, real-world assets, RWA, which are tokens representing tangible assets like real estate or bonds, and that growing corporate adoption narrative we discussed. Those underlying foundations don't seem to be weakening, regardless of the short-term price swings.
Okay, that list gives us some clarity on where to focus our attention beyond just the immediate price action. So, looking ahead just to tomorrow, September 27th, what stands out to you? What should we be tracking immediately? I've got 3 immediate things jotted down for a listener to track. Number 1, the market reaction after this massive options expiry actually passes on Friday. Does the market immediately bounce, find some relief, or does the selling pressure continue into the weekend? That's key.
Definitely. The immediate aftermath will be telling.
Number 2, we need to track any specific statements from Fed or ECB officials. Anything about inflation, interest rates, or critically, those new U.S. tariffs. The crypto market is just hypersensitive to macro factors right now. Any word could move prices.
Absolutely critical. And number 3.
Number 3, keep a sharp eye on any updates regarding crypto bills winding their way through the U.S. regulatory system, especially the Genius Act for stablecoins.
Right.
Any positive progress on clear, well-structured stablecoin regulation could drive immediate optimism, specifically in the stablecoin and DeFi sectors.
Yeah, that could happen largely independent of the current macro noise, actually. That regulatory clarity could genuinely spark a sector-specific rally if news breaks.
Okay, well, that pretty much wraps up our deep dive for today. It feels like the crypto market is currently being steered by this really complex convergence. You've got global macro decisions, unprecedented institutional integration happening through these sophisticated ETPs, and this massive psychological shift, right? Evidenced by the fear index dropping deep into panic territory.
So what does this all mean for you, the listener?
I think the takeaway is that the foundations for long-term sustained growth, specifically things like corporate adoption and the slow march towards a regulatory framework, those are being built now. Quietly, perhaps, but they are being built even as this short-term volatility reigns supreme.
Building on shaky ground, maybe, but building nonetheless. Well put. And this leaves us with a final, maybe provocative thought for you to consider. Given the serious development of CBDCs by major central banks like the ECB, and at the same time, the accelerated corporate adoption of Bitcoin as a treasury reserve by now over 75 public companies, which factor do you think will ultimately be the more powerful and permanent legitimizer for digital assets in the decade ahead? Is it government acceptance via state-controlled digital currency, or is it decentralized, mandated corporate adoption integrating Bitcoin into the existing financial system? Something to think about.